As we get into calls, I want you to think of calls as making a down payment to purchase something. In the example that we're going to talk about that's very relatable to us, I want you to have an analogy in your mind of purchasing. Well, first of all, you agree on the purchase price with the seller, and then you're going to be requested to make a down payment to show that you're serious about buying this. Well, typically, a down payment could be some percentage of what the purchase price of the home is. In this case, it's 5%. So you're making a down payment to the seller of the home, and in return, the seller is giving you the right to be able to buy that home. So let's look at a transaction of what buying a house might look like. So you place a down payment on your home, and the developer issues you the right to buy the home. So let's focus on the left side where you actually purchase the home. What does that transaction look like? Well, from the developer's point of view, they keep the down payment, and in return, they're obligated to sell the home at the agreed upon price. What price? $400,000 in our example. You, the buyer, pay your down payment, and in return, you receive that right to buy the home. And you want to purchase this home. And those are the steps that happens whenever you purchase a home. When you don't purchase a home, what happens? We're past the down payment area here. The developer keeps the down payment. You, the home buyer, pays the down payment. So you could actually lose that down payment. Now, why would you ever not purchase a home? Well, if you found out that a landfill was going to be put up next door before you closed on the house, you might say, hey, I don't want to buy the house. It's not worth $400,000 to me. So the key takeaway here, whenever we're talking about the concept of a down payment, and remember, we're only talking about the concept. The buyer pays a down payment, the seller receives a down payment. The buyer is getting the right to potentially buy something, where the seller has the obligation to potentially sell something. Since we just went over what a home transaction looks like, let's look at how similar it is to what a call transaction looks like. So again, it's on your stock by buying calls. The call writer or the call seller sells the price reservation. So again, let's start on the left here. So if the stock settles above the strike at expiration, what's going to happen? Well, the call seller, they keep the premium, very similar to a down payment with a home, but also the call seller is then obligated to sell stock at the strike. Okay? The call buyer pays the premium, similar to a down payment, and then what? They secured their right to buy the stock at the strike. So it's similar to a down payment transaction for a home. Now again, just like whenever we went over put options, call options on the right side look very similar. So let's go through that transaction. If the stock does not settle above the strike at expiration, what happens to the call seller? Well, they keep the premium and go about their day. They have no obligation to sell stock. The call buyer, you, just pay a premium. And so that's your risk. So now it's similar on the right side of the screen that if you're putting a down payment on a home and you don't want to complete the transaction or something changes not to your liking, you can then walk away and all your risk is just the premium that's spent.